Good afternoon, everyone. My name is Dale Brethauer. I'm going to be talking to you today about how you can trade the weekly options successfully. Weekly options can make you a lot of money, can take it away from you very fast because it's a quick instrument. We want to get in, we want to get out, we want to take our profit or minimize our losses quickly. Let me just say a couple things more about me. Renee was nice, said I've been trading for 30 years. It's actually 35 plus years now. I do this for a living, and I'm getting to the point in my career where I've done very well in the market, and I like to share my learnings with others so that they can become successful too. I am a hedge fund manager with Options Infinity Growth Fund LLC, but I'm really proud of the website we've put together for stock option education. I believe it's the best educational website out there for options. It's www.optionsinfinity.com. Then I'm going to show you at the end of the webinar how you can become a free member. We've got a lot of free content, and I really want you to know about me, hear me, see what my strategies are before you would go any further. Okay, today what I'm going to be talking about is the previous speaker was talking about focus. I think focus is very important in the market. There are over 7,500 publicly traded corporations and a huge amount of ETFs. I focus on two that give me a lot of diversification. They are the Standard & Poor's 500 ETF SPY and the TLT, the bond ETF. They give me great diversification, and they give me enough signals to keep me busy. What we're looking for is explosions in either one of those two. Are they overbought? Are they oversold? And if they are, then we look for a measured move in the opposite direction. We're going to stay with that move until we get an exit signal using Fibonacci's. And I'm going to be going over exactly what those three terms are and how I use them and how you can use them. I'll be going over some actual trades with you, talk about some trading tips, and then we'll go to my website and I'll show you how you can become a free member. Okay, let's take a quick look at volatility bursts due to it being overbought, oversold, and how you can use a measured move to identify that it is ready to change direction. This is an example of a regression channel put on the SPY, and you can see the purple line here is the regression line. The regression line is an excellent trend line. It's calculated by taking 50% of the price above it and 50% of the price below. So any point along here, that's the way that point is calculated. The green line is the plus or minus 1 standard deviation of that regression point. The gold line is plus or minus 2 standard deviations. Now, this is a very important concept. This is the regression channel I used way back when, before trading platforms like Thinkorswim, and I do use Thinkorswim. I think it's one of the best out there. I'm not affiliated with them, but this is automatically done. I used to spend hours in the evening updating my regression channel. I've been doing this for years. This is one of the best tools that I have in my quiver of arrows. The regression channel, it very seldom does it go outside the plus or minus 2. Yeah, occasionally it does, but it's considered an outlier. and it'll soon come back to the mean. And a lot of times, if you think of this as a magnet, a lot of times it'll come up here and it'll be pulled back with such amount of force that it'll then bounce the other way and continue on. The regression channel, most platforms you can just go ahead and get that. Okay, let's talk a little bit more about the +1, the +2, the -1, the -2 on the standard deviation. Statistically, the 68.2% of all prices will be contained within the ±1 standard deviation. Then when you go to 2 standard deviations, that was the gold line on the previous chart, 95.4% of all prices are contained within the ±2 standard deviation. 95.4%, not 100%, 95.4. And oh, by the way, as I'm going through here, if anybody has any questions, go ahead and type them in the box. I've got the box open right up in front of me. And if you have any questions, I'll stop where I'm at, try to get that answered for you, so that once you have the answer, you can continue listening to me. You're not sitting there thinking about your question. I don't have any yet, so I'm keeping an eye on that. Let's go back real quick to the previous chart. So basically, if you think of this ±2 standard deviations, remember 95.4% is contained within that channel. It's almost like this is the coating, if you will, on a sausage, and this is the meat within. Yeah, occasionally you will have an outlier, but shortly thereafter it's going to be pulled back to the mean. This is an extremely powerful indicator. The second thing I'm looking for is measured moves. A measured move, a bullish measured move, is, let's say the market is coming down and you get to a point where you've got a low and then it rebounds a little bit. It pulls back but makes a higher low. It makes a higher low. And then it continues on to the upside and makes a higher high. This is a classic definition of an uptrend. Higher highs and higher lows. When you have this measured move, it confirms, okay, you were oversold, you're oversold, and now the market has turned around. You have a measured move to the upside. You've changed directions from down to up. That's a great time to enter the market. Not only that, once you have a measured move, you can put on a Fibonacci. Now, most of the trading platforms have this automatically, where you just choose the Fibonacci tool. You click on A, drag it to B, click on B, drag it to C, and it will automatically put in the Fibonacci extensions. Now, just the opposite is true for bearish measured moves. Bearish measured move, you're starting at the top, it comes down, it comes back up, but makes a lower high, a lower high. Then it comes back down through here and makes a lower low. That is the classic definition of a downtrend. Lower lows, lower highs. And it'll continue in these trends until it turns around. Once again, you could put on a Fibonacci by clicking on A, drag into B, click on B, drag to C, and it'll automatically put on the Fibonacci extensions. Now here's an example. You can see on the SPY how overnight it came down, then came back up, but it made a lower high. It came down here and confirmed that this was a lower low. This was a change of direction and continued on down. It got down to here. It's down to the -2 on the regression channel. So what do you think is going to happen? Yeah, there's a good probability it's going to turn around and head back up. Sure enough, it makes a measured move right here to confirm it made a move up, pulled back, it made a higher low, and then a higher high, okay? And off it goes. Now, once you have this is the entry basically. You're looking for something that's overbought. You're looking for a measured move to the downside. You're in. Down here, you're looking for something that's oversold. You're looking for a measured move to the upside, and you're in. This is a great entry timing tool. But getting into a trade is only half of it. Getting out of it, I think, sometimes is even more important than the entry. A lot of people focus on the entry. I focus on the exit. You know, the old adage is you want to let profits run and cut your losses short. Well, how big of a profit do you take? When do you say enough's enough? Using the Fibonacci's to see where you're overextended is a great place to get out. And not only that, but when it shows you when to get out, you want to get out when it's moving in the direction. Here I had a short or a put, and it's good to get out when it's heading down because the premiums are going to be the highest. Same, just the opposite is true when it's heading up. And somebody just said, yeah, that'd be a nice problem to have. When is enough? But I'm going to show you. I'm going to show you when the Fibonacci's are going to tell you when enough is enough. And that's what happens. A lot of people stay in too long. They stay in the trade. Hey, it's made money for me to this point. I'm going to stay in and make a lot more money. And that gets a lot of people into problems. Now let's take a look at the Fibonacci's. You want to exit the trade using Fibonacci extensions. The Fibonacci's are derived from a number sequence that was put together by Fibonacci, the mathematician, way back in I think it was the 17th century. What he did is he adds the current number to the previous number to get the next number in the sequence. This is the sequence. 0 plus 1 is 1. 1 plus 1 is 2. 1 plus 2 is 3. 2 plus 3 is 5. 5 plus 3 is 8, and so on, and so on. This is the Fibonacci number sequence. Now, when you take any number divided by the previous number, you get 0.618. This is called the root Fibonacci ratio. 0.618. I'm going to be talking about that on the next slide. Remember that. 0.618, the root Fibonacci ratio. Well, then along came some mathematicians, and of course they like to take the square root of that and the square of it. And while you're doing that, why not take the reciprocal of that? And these came up with the numbers that we use for Fibonacci extensions. Okay, exiting with the fibs. So down it comes, then it pulls back, then it makes a measured move right here. At this point, you can put on the Fibonacci ratios. Here's the 127, here's the 161, here's the 261. Most times it'll come to the 127. 127. And that's the number I have as a default on my Thinkorswim platform to come up with the 127. At the 127, you know it's either going to pull back, consolidate. If it blows right through, just like it did on this case, you know it's probably going to go to the next level, the 161.8. And sure enough, it did. Well, what's it do down here? It consolidates. It consolidates. It consolidates. Get out. get out. Take your profit. Take your profit and get out. Probability of it going all the way down to the 261 is slim. Take that profit and get out. Don't wait for additional profit. You've got a heck of a nice profit here. Take it and get out. Now, let me go back here a second before I get into some actual trades. Let me see here. Let me get back here. This 0.618, this is seen throughout nature. If you go out into the flower garden and take a look at the stem of a flower and measure from the ground to the first leaf, and then measure from the first leaf to the second leaf, and divide that, you will see that the leaves on a flower grow according to the root Fibonacci ratio, 0.618. Let's take the human body. Your bones grow to the ratio of the Fibonacci root ratio, 0.618. If you look at your forearm, the bone on your forearm, and divide that into the bones from your wrist to the end of your hand, you will get the Fibonacci ratio 0.618 or close to it. Most of the bones in the human body grow to this proportion. This root Fibonacci ratio is seen throughout nature. Doesn't it make sense that if this is seen throughout nature, that it would be applied to the stock market? Because where is human nature played out on the big stage? In the stock market. Fear and greed, human ego, everything is played out. Okay? Michael, that's too much. Michael says the Fibonacci's were used to map Trump's hairdo, and it was accurate too. That's really funny. I haven't heard that one. Okay. So here's the first actual trade that I took off. Made this August 1 using the SPY, and on August 1 I saw that we were at this point here between the +1 and the +2. That's overbought territory. I'm looking for the SPY to go back to the mean. I'm looking for it to go back to the mean. So down it comes, it pulls back, it makes a lower high, it makes a lower low, and I'm in. I'm in. I got in with an August 216.5 put at $1.31. Let's take a peek at the option chain on that. Okay, here's the 261.5 put, and I got in at $1.31. All right, so now I'm in. So now what do I do? Well, once it makes a measured move, I can put in the Fibonacci's. There's the 127. Here's the 161. Here's the 261. The 127, it blows right through. So what do? I look for it to go to the 161. It blows right through the 161. Now what am I looking for? I'm looking for it to go close to the 261, and then it comes down into the -2 on the regression channel. That combination right in this area right here is get out. That's enough. Enough is enough. That's how you know when to get out. Okay? When I got out, I actually got out right down here. I got out for that August 261.5 put was worth $2.75. That's 144%. You know, a lot of people say you don't want to buy options. You don't want to buy options. You want to sell options. That's true. Most of the time that is true. But when you're dealing with the weeklies and you get something that's overbought or oversold, and you get something that makes a measured move, you are in and you are out quickly. okay? And that's the way to trade these. That's the way to trade these. Okay, Frank says, I've often heard that a credit spread may have 85% success rate. If you do the complete opposite, would that debit spread have the same? Okay, I like credit spreads myself, Frank, and when you say 85% success rate, that's pretty high. That's pretty high. You know, if one of the things to be a success in the market, and I'm glad you brought this up, you really have to be a conservative trader and you have to embrace losses. There are going to be losses. There are going to be losing streaks. There's going to be losing strings, and you've got to adjust your trade size to what your portfolio is. You don't want to overtrade. That's one of the things I teach on my website. I teach you for a given portfolio, what is the best trade size? I don't know that credit spreads are any better than debit spreads. They're working on the same thing. The only thing is with the credit spread, you're actually selling. You're actually selling here. You'd be selling a call and buying one further out of the money. It's a more conservative trade than buying straight out. And in the long run, if you've got a longer trade, I think they are better to make. However, what we're doing on the weeklies, we're trying to get a quick pop and get out. So I think buying the puts and the calls directly is the best thing to do. Here's another example that happened that same week. Now, we said it came all the way down here to the -2 and a Fibonacci extension. What do we expect it to do? Well, we expect it to go back up, and it starts to. And it comes up here, and then it pulls back. It makes a higher low. Okay? Then it makes a higher high. It has changed directions and confirmed that. Okay? Now, a couple points. You could have gotten out right here, or you could have waited a day and got out right here. I like to take the shorter ones, and I did. I took this shorter one. I didn't wait for this long one to happen. Would I get back in at this point? No, because it's not overbought. Overbought is up in this area up here. Down here, when we got the measured move, I bought a 13 August 216 call for $1.45, and I got out right up here. Right up here at 241. That's 66%. 66%. Here's the option chain on Thinkorswim, and here's this shows where I got in. Now remember, when you put this in, never go in at always go in at the midpoint. The midpoint is determined by the difference between the bid and the ask. You don't want to pay the ask price, and when you get out, you don't want to pay the bid price. You want to go in at the midpoint. It might take you a little bit longer, but it's going to be worth it in the long run to go in at the midpoint. Wait for it to be filled. Now, those two trades that I just showed you that happened the first portion of August, the actual trades, 210% in 5 sessions. 210% in 5 sessions. This happens all the time. Now, a lot of people say, well, Dale, you know, I can't watch the market all day, and that's fine. I don't watch it all day either. I don't. What I do is usually first thing in the morning I come down into my study and I check what's going on in the overnight market, and then before the market opens will be my analysis time. In a quiet room, I'm analyzing what my plan is for the day. Okay, if I've seen the potential for a measured move, I know what I'm looking for, and if it's a completed measured move, I'm in. I immediately put on the Fibonacci's and I know when I'm going to get out. Okay, I watch the opening. I watch the opening from 9:30 to about 10:30. Then I go about my business. I usually come back around noontime and touch base to the market and see how the trades are doing. And then I'm out. And then I always come back towards the end of the day between 3 and 4 o'clock because that's when the big boys are trading. Love to watch the close. Okay, just touching base with the market 3 times a day will allow you to do this strategy. You can do it on your phone. You can do it on your cell phone. You know what to look for. You're looking for something that's overbought, oversold. You're looking for a measured move. And then you're looking for a profit zone, and that's the Fibonacci's. It's pretty straightforward. It's about as simple as you can get. And I think if you're going to be a success, you've got to keep things simple. Here's just one more example of something I did in April of this year. And that was, you know, you can see up here, it had made a high. It was overbought, came down, came back up. What's this right here? That's a measured move. Overnight it blew through the 127 to the 161. I couldn't wait for it to open. Well, it kind of went against me, but when we had this bar right here, I was out. I was out. Got in here about 2 o'clock, got out here about 10 o'clock, 71%. And I knew I didn't have anything to do the rest of the day because I had made my money. And in the morning, I looked at this thing and says, you know, it might be having a major move to the upside. It's once you get the hang of this, it's a pretty simple thing to do. All right, let me go over a couple successful trading tips. You don't want to overtrade. One of the rules of thumbs is if you feel any anxiety while a trade is on, you've got too much at risk. And remember that these trades usually start out losing, and there's going to be losers, there's going to be losing streaks. So adjust it accordingly. And once again, you can go to my website and see what a reasonable trade size would be. Don't be too quick to take profits. Take profits at the fibs. Let the trade evolve and know when enough's enough. If the direction seems obvious, you want to take it. You want to follow the rules. Okay? Now, if you get a reverse measured move, that's when you get out. That's your exit. This is not going to be 100%. You got to have an exit strategy too. Okay? I can't overemphasize this last one. Start small. So many people go to these things and they listen to this and they get all fired up and they put in all their money in the very first trade and it loses. Well, naturally it's going to do that. You've got so much anxiety running on that thing, you're going to exit early, you're going to make all kinds of mistakes. Paper trade and learn how to do this. If you can't make money paper trading, you're not going to make money when you put real money on there. Okay? A lot of people say, well, if I paper trade and I have a big winner, I missed that. No, you didn't. You're learning how to do it. Okay, now let's go over to the website. How do you learn more? We're going to go to www.optionsinfinity.com. And the first thing I want you to do is become a free member. Free member. I want you to take my classes. I want you to listen to the webinars. On the website, I teach my 3 strategies. The strategy on trading the weekly options, strategy on swing trading the trend, strategy on credit spreads, longer term credit spreads, taking advantage of the decay and theta. I want you to learn those. I want you to learn those. So let me just show you what you're going to do. When you come over here, you're going to go on to www.optionsinfinity.com, optionsinfinity.com. You're going to see the very first thing is the SPX, the weekly option regression. This is my latest, best of the best strategy. I'll come back to that in a second. But if you scroll down here, I want you to come down here and hit this button and become a free member. Become a free member. Okay. Once you're a free member, you have instant access to my 3 strategies. Swing trading, the trend, credit spreads, weekly options. Then, if you're brand new to this, I've got something here on options 101. I talk about the leverage of options and how it can work to your advantage. Talk about how I pick my market basket. When I trade options, I only have 25 stocks that I follow. Remember, we said earlier, you want to focus. You want to focus. You don't want to shotgun this. You want to focus. And on the weekly options, what I have is 2 that I focus on. For the swing trade, I've got 25 that I focus on. In credit spreads, I have 3. I teach you how to set up your charts just like mine. What's your proper trade size? You want to become a disciplined trader and stay in this game and become a success. You need to know how much money you can put on every trade. And this little webinar shows you exactly what to do for your given portfolio. Something on the psychology of trading. Renee was telling you in the earlier thing that I give a lot of credit to Dr. Van Tharp, who was a psychologist. He taught me a lot. 1, you got to learn how to check your ego at the door. 2, you got to learn how to stick to the rules. 3, you got to learn how to control how much you're putting on. You got to have good money management. That's the trade side. And I'll show you everything that I learned there. I want you to be a success. This is an indicator I've come up with. It's proprietary, but I'm going to share it with you. It's the macro MACD. It's the weekly version of the daily MACD. We talk about the mean regression channel, and I'll go into that in greater detail. Here's more about the Fibonacci's, okay? And, so on and so forth. There's plenty of free information. Now, let's say you look at that and you say, man, this is good stuff. This guy knows what he's talking about. Well, I better. I better. This is how I've made my money for all my life after DuPont. This is my very best strategy. It's the SPX weekly option regression war. And it took me a year to develop this. I've been doing it for 2 years, and I've back tested it for 10. Click the Learn More button, but only do that once you've become a free member and you say to yourself, hey, this is cool stuff. I want to go further. I want to go further. Okay, scroll down here and listen to me. Listen to me talk about why I developed this. What was the hypothesis? What techniques am I using? It's about a 40-minute webinar on the strategy outline. If you like it, you might want to sign up. If you sign up, you're going to get 4 video courses that go over step by step the overview, the rules, the entry and the exit, the performance, and so forth. This is something that a lot of my students have been screaming for. Dale, I love what you're doing. I see what you're doing. Can you tell me when you're doing something? Okay? And this is the first time I've come out with real-time email alerts. They're not recommendations. It's what I'm doing. You have to learn this. You have to decide if you want to do this, but they are real-time alerts. And then once a month, we just had one this morning, a Q&A session where we talk about their most recent trades and answer any questions that the group has. Now, this is an equity chart showing the kind of returns I'm getting. Notice there's a very little drawdown as we go along here. Very little drawdown. It went from 0 to 25,000 in less than 2 years. And this was based on $500 per trade. Very conservative, super equity curve. losers. There's some losers in there, okay? But everything, you know, if you get an equity curve that goes like this with not much drawdown, you got a winner. All right, you like that and you say, I want to go ahead and do that. What I want you to do is, I think when I was doing this, you saw the little pop-up button that said it's closed right now. This is closed right now. I keep it to a minimum of people. There are right now 200 people in this strategy, and I don't want to have any more than that. So and some of them have been there for a long time, and it's just like anything else. It's easy. It looks simple, but you got to get in there and you got to do it. You got to paper trade it. You got to have a loss. You got to see what it's all about. You got to come up the learning curve, and then you've got it. But anyhow, when this pop-up button comes up, say, hey, when you open it back up again, I want to get in. Not only do I want to get in, I want to take your discount off the previous price. And we're going to give you ready for this? All that for $97. All that for $97. Okay, so when the if you see this, you like what all the education is, what I'm teaching and everything, and you want to go further, but when that pop-up button comes up, go ahead and click on it. You'll be sent a link that will allow you. It's a coupon when you go to purchase it. And I think the next time we are opening this up, I was talking with my IT people the other day. What did they tell me? I think it was August 28th, Sunday, August 28th. What are we today? The 17th. So it gives you some time to become a free member, look at the website, see if it makes sense to you. Go ahead and there's no obligation. Go ahead and get the link of the coupon to knock this down to $97 and come join me and let's have some fun. Let's have some fun. Okay, so that's that's pretty much what I had. Let me see if I have anything else here. Renee, this is just the last chart. Oh, here we go. The first trend. There's 20 spots. There's 20 spots available, and that's going to be open on the 28th. Like I said, it's currently closed, but we are going to open it up on the 28th and bring in another. Here's the pop-up button that you'll get. That is $97 per month, and you know, $97 per month. I mean, if you make that on, if you're trading a minimal account, and you can do this with a very small account, you're going to make that back and more. And that's the way I like it. Make money as you're learning this. This is what the pop-up button is going to look like. You're just going to put in your first name, last name, email address, hit the get offer. We're going to send you the link that when it becomes open on August 28th, and we'll send you an email saying, oh, remember, we're going to open this up on August 28th, first come, first serve. Here, get your coupon ready, and you know, and come join me. Okay, Renee, that's what I've got to say.